Hello, I hope this finds you well. Happy October. It's hard to believe that we are in the home stretch of 2020, and perhaps some of us are happy about that because 2020 has been quite a challenging year for many reasons. One of those reasons has been the increased market volatility, which is what I wanted to talk about today. And specifically that as long-term investors, we have to deal with market volatility and realize that it is normal and it is to be expected. There's a reason I'm sitting next to my whiteboard wall here in my office with an oversimplified visual that I share with clients when they walk in about what is normal market behavior and what is not normal market behavior. But I thought I would share some data with you today about just how normal market volatility is. So if you look over the past 50 years in the S&P 500, the average intra-year sell-off has been about 13.8% per year. So in other words, if you were invested in the S&P 500 stocks over the past 50 years, you would have experienced your portfolio decline about 14% roughly once per year. And since 1950, the S&P 500 has also declined by about a third, or 33% on average every 5 years. So here's the good news though. Is 100% of the time that the S&P 500 has declined in the past, it has come back 100% of the time, including in 2020. So in order for us to understand what the long-term picture in the stock market looks like, I think it's important to zoom back and take a look at what happens over the long run. Over the past 70 years, the average returns for the S&P 500 have been about 11% per year. But in order to potentially enjoy these returns, it's recommended that we are in the market for the long run. There's an old industry adage that says it's not timing the market, but rather time in the market that counts. And even though the S&P 500 is not positive every single year, over the past 50 years, it has been in 40 of those, or about 80% of the time. So I understand that it can be really nerve-wracking to look at our portfolios and see them decline substantially, especially over such a short period of time like what we experienced earlier in 2020. Back on March 23rd of this year, the S&P 500 had declined 34% from the all-time high that was hit back on February 19th. But check this out. One day short of 6 months later, in August, not only had the S&P 500 gotten back to where it closed in February, it had actually surpassed that. But also, if you were invested in the S&P 500 from August of 2019 to August of 2020, you would have experienced about an 8% increase in your portfolio year over year. So the other thing I want to share with you is normally the best performance days occur around the worst performance days. And to put some numbers behind this, if you were invested in the S&P 500 from January of 2000 to December of 2019, you would have enjoyed average returns of about 6% per year. However, if you missed just the best 10 days in that 20-year period, your returns would have declined down to 2.44%. So think about that. That's the 10 best days over a 20-year period. And if you had tried to time the market, your returns would have declined substantially. So if we're not supposed to sell when the market goes down and we're not supposed to panic, what are we supposed to do? What I recommend is that we manage our portfolios and we make investing decisions in line with our financial plans and also our goals. So instead of letting market volatility or the current crisis, whatever it may be, drive our investing decisions, we come back to our financial plan and we come back to our goals. One of our processes in our practice is when we're sitting down with a client for a periodic review, we go over the volatility profile of their portfolio, and we can tell them with a high degree of probability what a range of returns would look like in their portfolios over different market environments. The reason this is important is because they know what to expect. So when it happens, when we go through another bout of market volatility, which we will again, I promise you, they know how to react. They're not going to panic because they expect it. I always tell my clients, I don't want you to be happy when your portfolios are down. I'm not asking for you to be happy, but I am asking for you to stay committed and stay disciplined to our financial plan that we've set out for you and to your financial goals, not to let the market volatility impact that or derail that. And here's the thing, it's really important to review the volatility profile of your portfolio, not during the middle of a crisis or during the middle of a panic period, but rather during a period of calm. And I mean calm in the markets and also calm in your minds. If you are looking at your portfolio and the volatility profile when you're panicked or when there's panic around you, you're probably not going to make decisions that are in your best interest. But rather, if you are calm and there's calm around you, perhaps you can make a better decision that's in your best interest over the long run. So I hope this was helpful. All this to say, market volatility is up there with death and taxes in terms of certainties. I hope that you can use this video in the future as a reference point when we do hit more market volatility. If you have any questions, please feel free to reach out and take good care.